Welcome to the Wealth Matters podcast, where investors come together to better understand how to build passive cash flow and create generational wealth without all the confusing mumbo-jumbo. Here's your host and co-author of Amazon #1 bestseller, Alpesh Pamar.
Welcome to Wealth Matters Podcast. I have Mr. Bernard Reisz with me. He's a financial expert. I call him as the guru or anti-guru, but he has heavy focus on real estate, entity structuring, and self-directed retirement accounts. Welcome, Bernard.
Alpesh, thank you so much for having me. I've been looking forward to doing this. This is going to be a great episode because it's January 5th, Senate runoff day. There's a lot in the balance. So this is going to be timely and exciting.
Yeah, absolutely. We were chatting about that right before I started recording, right? Today's the day that would decide the Senate race. So it's going to be interesting what happens to tomorrow or, in a week or so. But, this would be a timely podcast because we want to discuss about the tax plan for our upcoming president, Mr. Biden.
Yes. Let's dive right in. There's a lot going on, and what's important to understand is overall the focus of his administration is going to be to raise tax revenue one way or another.
Hey, so before we get started, tell us something funny or interesting about yourself.
Funny and interesting about myself, I tend to see themes in all sorts of interesting places. I've got kids, and one of the questions I get asked on podcasts sometimes is, "What books do you recommend?" Right. And I would say I recently read with my kids a series of books, The City of Ember, and it's a whole series, and I encourage everybody to read that. And I wonder if people will see the depth that I see in it. Depth for navigating the world, depth for navigating finances, a lot of profound lessons there, but it's a kid's book. It's a kid's book. So some people may find that odd that, hey, Bernard recommending a kid's book. I think I'm curious if you read it or anybody else reads it. It's an entire series. And I saw an incredible profundity in these kids' books.
Okay. So I love reading as well. Of course, I haven't been able to keep up last year, even though I was more at home because kids were at home too. But
yes,
my kids are book lovers too, like me. So I'll definitely, look into buying those books for them and read with them.
Okay. Yeah, let me know.
Yeah, I will. And do you invest in real estate and why?
I certainly invested. Okay. I certainly invest in real estate, both equity and debt. That means to say both as a lender and as an owner. Real estate, I think everybody, while I think everybody can find their own path, generally speaking, I think everybody should include real estate to one extent or another in their portfolio. And I think if you can get past the risks, you're going to get a better return if you're investing in private real estate as opposed to using a REIT. All right, as opposed to a REIT or as opposed to crowdfunding. You're going to get a better deal if you're investing in private opportunities. Of course, private opportunities means you really have to get comfortable with the operator. You really have to do your due diligence. But once you cross those hurdles, the returns and their performance are most likely going to be far better than any other route.
And I'm glad that you brought it up. So as you said, the returns would be far better, but also do not forget about the tax benefits. Right? If I invest in a REIT, it's a stock. I could have short-term or long-term capital gain. That's about it. But over here, even with the return, you could have depreciation benefits, right? And that itself is huge.
Yes, the depreciation, the tax benefits, real estate do not exist when using a REIT. REITs are actually taxed in a way that's unfavorable.
Oh, really? Okay.
So REITs do not have great tax attributes. So certainly REITs, just by their very nature, they're not going to be, the investments generally are not going to perform as well. What makes private real estate great is that you're having an operator or somebody that's doing the acquisitions that has the inside scoop on a local market. They know the deal. It's the fact that it's private, and you're able to move nimbly, take advantage of opportunities, is what makes it so good, right? The stock market, and very, very large companies are constrained by what they can do. The stock market, we know to some extent or another, is an efficient market. So you try to pick stocks, generally a loser's game, right? So the buying stocks, you're best off doing something passive, and it's a spectator sport. You can't influence the outcome.
Right.
Large REITs generally cannot be as nimble as smaller operators. So there may be some measure of safety in a large REIT, and you can invest small slices, and you can do it through your brokerage account. But it's the operators, and a smaller operator doesn't mean a triplex. You're buying properties that can have hundreds of units. But it's because they're private. It's because they're not publicly traded. They're not available through the stock market, that the operators are able to squeeze out more value, and actually influence the outcome. It's not just watching stuff go up and down. You can influence the way things go, and you can see unique opportunities, which you cannot get in publicly traded stocks.
That's awesome. And the reason I brought up tax is that my next question is about, because I saw your bio and you mentioned about some tax mitigation strategies. What are some of the advanced tax mitigation strategies you help investors with?
So when we help investors with tax strategy, well, there are two types of tax strategies. There are the ones that are, I call, completely above board. Mm-hmm. And then there are the ones that have certain amount of risk associated with them. Right. So the great thing about real estate is that real estate has many incredible tax benefits that don't require taking any tax risk. Right. Right. There are other areas of taxation, or many things that are proposed that have risk, and oftentimes the people that use many of these tax strategies that are sold out there don't understand the risks that they're taking. In real estate, the beauty is the tax benefits are there. They're above board. There's no question as to their legitimacy. So when you're using depreciation, when you're using 1031 exchange, when you're accelerating depreciation using cost segregation, when you're using your real estate professional tax status, right? Assuming you qualify, right? We know the rules, and we know how to apply them, and there is no question as to their legitimacy. There's another set of tax things out there that go into, so when you start talking about conservation easements.
I was going there. That's one of the risky ones.
Now, here's the thing, conservation easements. Today, everybody, or most people, will know, many more people will realize that they have risk associated with it. But say 5 years ago, right, when it wasn't yet headline news.
Right.
Yes. Right. At that point, people were selling them right and left. And then there may be somebody saying, hey, there's risk here, and everybody ignores it. Right. Yeah. But that person was right. Now, that does not mean, when we say there's risk, it does not mean that you should not do it. It just means that the people that are selling these things are not giving you all the information you need to make an informed choice.
Yeah.
That's what it is. There is no right or wrong. So when somebody talks conservation easements, captive insurance, certain life insurance strategies, certain QRP tools, certain, let's say, installment sales transactions.
Yes. Monetize installment sales.
So everything has its place. And certainly if you understand the pros and cons, you can proceed. But what tends to happen is people are not really working with the full set of information. So to recap, there are some great real estate has so many things that are just above board, no risk.
Yeah.
And then there are other tools where there's risk associated with it, and people don't understand it. And of course, we're not talking about the type of tax tools that may be promoted where people are almost blatantly being misled, right? Say conservation easements and monetized installment sales. Those are presented more or less as what they are, but there's certain risk associated with it.
Yes.
But then there are other things that are promoted and sold where people are actually being totally misled. But again, the beautiful thing about real estate is we have beautiful strategies. We have depreciation. We have cost segregation.
Right.
We have 1031 exchange. We have long-term capital gains treatment. It's a tax nirvana.
Yeah, I agree.
That's what real estate is.
So let's talk about, now that you brought up real estate and you already mentioned some of the, 1031 and monetized installment sales and depreciation. What do you think could be, because we don't know, right? Some of the upcoming tax changes in the new, president, under new president.
So there are two things that may happen, and it's either or both, right? Or all possible. Number one is legislative changes, potentially, and number two, enforcement. So if the Mr. Biden and his incoming administration have said that they intend to target real estate, potentially eliminating 1031 exchange, potentially raising the rates on long-term capital gains, potentially tampering with how depreciation is used in general, and more specifically using depreciation to offset other income. So perhaps like a real estate professional can use.
Yep.
So they have mentioned all of these. We don't know what they'll be able to do. Now, if the outcome in the Georgia Senate race taking place today gives them the power they need to make sweeping legislative change, that's on the table. What they can do, even if they don't get the control of Congress that they need, the Congress is one branch of government, that's the legislative, but they will control the executive branch, right? And so the executive branch includes the Treasury, which includes the IRS. So the Treasury and the IRS, they write the regulations. Congress, the way tax law is structured, Congress writes the laws, and then the IRS is tasked with writing the regulations, the regulations, which is in a way the interpretation of the rules and how they're implemented and enforced. So the IRS has some latitude there. All right. Are they going to interpret it favorably for taxpayers or not favorably? And then, of course, the IRS they walk around with the big stick, right? But the last couple of years, that stick has been taken away from them.
Right.
But even if they don't control Congress, they can give the IRS back their stick, which means to say that questionable, there'll be more enforcement, and more questionable strategies may come under greater scrutiny. So interestingly enough, if they don't get to change any of the laws, I think real estate remains the best place to be because 1031 exchange is above board. Real estate, it's all there. But other things that are questionable probably going to get some greater scrutiny.
Got it. And what about have they talk about opportunity zones as well? Because that was one of the pays which is part of TCJA, and that's huge because it's I call it as 1031 on steroids because I don't have to invest the entire amount. I can just take the profit off of even stocks and crypto and put it in opportunity zone and don't have to pay tax on it for 10 years if I keep it. And then I can pay the tax, but I don't have to pay the tax on the investment I have made.
So I doubt they would tamper with opportunity zones for a couple of reasons. But one is opportunity zones, in a sense, are gradually going away anyway. Right. The ability to eliminate opportunity zones have multiple layers of tax benefits. One way we can view it is how it impacts the gain, the taxable gain from the investment that you exited, right? And so you had that gain. What do you do with that gain? So then there is the potential taxable gain on the investment in the opportunity zone, right? So those are the two sides to it. So over time, they're all going away, just the way the initial law is written, and particularly the portion that allows you to eliminate taxes on your initial sale. That's winding down on its own accord. So I'd be very surprised if they tampered with that. And also, it's undoing so many things, so many projects. I would be astounded if they tampered with that.
Got it. No, and what about I also heard estate tax. They may tamper with that.
Yes. There's really no good way to do that. There are a couple of different components of the estate tax. And this is important to real estate investors as well, especially important. So, within real estate, use of a 1031 exchange has generally allowed investors to swap till they drop.
Right. Yep.
Swap till they drop. So let's talk.
Keep it till you die, right? And then your heirs don't have to pay any tax.
Exactly. So let's talk about how that works for a moment, just so the audience understands what may happen with the estate tax. So there are two potential taxes when someone passes on assets to heirs. Number one is when people think estate tax is a tax on the right to transfer assets. So if you transfer assets, you transfer $20 million in assets to your heirs. I just picked the number, but it can be potentially any amount. There's a tax on the right to transfer, and the tax goes up to, say, 40% of those assets can be paid as a tax, referred to as the estate tax. The other potential for tax is, say, your heirs inherit that property, an asset, and now they sell it. They can have income tax. So if there's a property that, your basis in that, just keep it simple, the basis in the property was zero and the heirs sold it for $1 million, they would have $1 million taxable gain.
Right. Yep.
So what currently happens right now is neither of these taxes will end up applying to most Americans. Number one, currently the estate tax exemption is approaching 12 million and approaching 23 million for married individuals. So unless your estate is larger than that, at least at the federal level, there's no estate tax. The second thing is your heirs get a basis step up to the fair market value. So if you have a fully depreciated asset that your adjusted tax basis is zero, but it has a fair market value of $1 million, your heirs will get a tax basis of $1 million. So if they turn around and sell it the next day, no income tax.
And that's huge.
Yes, that both of these are huge.
Right.
Now, the Biden tax platform has mentioned reducing the estate tax exemption, most likely back down to about 5 million. It has been far lower at different times, but most likely to 5 million. And they've also mentioned removing the basis step up.
Yeah. And that 5 million also, of course, earlier it was lower, but you have to keep up with the inflation, right?
Yes, it is adjusted. It is adjusted.
So yeah.
It used to be at one point it was 1 million, then it was made 5 million. Generally speaking, whatever they make the number, that kind of serves as the base, and then it will adjust slightly each year for inflation. The question is, though, what's the base number? Are we starting at 5 million? Are we starting at 1 million? Or are we starting at 11 million?
Right. That would be interesting. So how can an investor navigate through these changes, right? Let's say some of these changes happen. What would you recommend, right? What would you look into, or what would you ask your clients to look into?
So one of the things that I try to people to understand about taxes is to view taxes the way they view investments.
Right.
And it's all about the same concepts. It's ROI, risk-adjusted ROI, due diligence, diversification. So, for example, what there's people are very familiar with the concept of diversification when it comes to investments. Yes. Now, you may be in favor of diversifying, or you may be against it, right? Some will say be diversified. Others say diversification is for people that don't know what they're doing. Right? Those are both valid perspectives. Generally, I'd say for people is in the stuff that you know what you're doing, don't diversify. And when you get into stuff that you do not have direct firsthand expertise, get diversified. Now, you also you can be tax diversified, which means to say you can have different buckets of assets and income that are taxed differently, so you can choose when and how you get taxed. So, for example, and this is interesting because it'll bring some of the other stuff, retirement accounts. Many real estate investors, and certainly full-time real estate investors, are not fans of using retirement accounts because they say using retirement accounts for real estate, if you're a full-time real estate person, gets to be a little cumbersome. And if you're a full-time real estate person, you have so many built-in tax benefits into real estate that you don't need the tax benefits of a retirement account. Well, if somebody is tax diversified, so then they would have a mix of your real estate, different investments, and they may have a traditional QRP or traditional IRA. They may have a Roth QRP, a Roth IRA, and that allows you to choose when and how to recognize income. So if you were to be generating income, now if we're worried, say tax rates are going up, the most powerful vehicle you can use would be Roth IRAs or Roth qualified plans.
Right.
Traditional IRAs, which are pre-tax, the beauty of that is you get to choose when you get taxed, right? So if you use a traditional 401k, traditional IRA, you get a tax deduction this year. And you get taxed on that whenever you actually take a distribution, right? So you can choose when to recognize that income. So obviously you can say, hey, I don't want to get taxed on this year. Maybe another either legislation will change, depending on age, obviously, but there's a factor, right? You can say, hey, let's put this in here. We have 30 years to think about when to get this taxed.
Right.
More than that, say I'm in New York, you're in California, right? Okay. Two most wonderful states for tax professionals.
The socialist state of California.
But if you're a tax advisor, these states can create lots of business. But say you're thinking of you're thinking, hey, right now I'm in California, high tax state, right? Okay, I'm going to take this income. I'm going to take a tax deduction this year. I'm not going to recognize a tax. I'm going to put it into a traditional QRP, right? Now I have 30 years to figure out when I'm going to recognize that tax, right? And maybe in 20, when I retire, I'm going to move to Texas or Florida, right? Where there's no income tax. Then I take the distribution then, and you just saved yourself 13.3%. Right.
So you have to take, at some point you have to take RMD, right? Required minimum distribution. Right?
Or you can convert it. There are RMDs, but you can convert it. You get to play with it. So you get the time. So you can take it when you're RMDs, you can move out to you could be in a different state. You can do the conversion. If you're saying, hey, this year, I'm moving out of California. Okay. Now you're in Texas. This is the year to do the Roth conversion. Pay all the taxes.
Yeah.
So
then move back.
So, and now, do you know though that the great state of California has suggested taxing anybody that leaves California for 10 years?
Yes, sir. I saw that. That's why Elon Musk is moving, Oracle and HP moving. So yeah.
But there's something called, but to bring it full circle, you can be tax diversified, not just investment diversified. You can be tax diversified so that you can figure out how to pull those levers of taxation depending on your personal circumstance and the laws in effect at a particular time.
Oh, that's awesome. So I don't know if we need to cover anything more, but I was watching the migration pattern, right? And of course, people are moving a lot after COVID, especially people moved out of New York, San Francisco a lot. So do you think the migration from blue state to red state will increase because of, upcoming tax changes? But it's already happening.
So do you want to hear something very interesting? The tax changes that will come will actually benefit blue states in a way. Perhaps. And I'll explain why. One of the biggest things that happened with TCJA was the SALT limitation.
Oh, that was huge.
Right? And that would encourage people to move to states that are low tax states, right, because you had no tax benefit, right, from your California or New York taxes. Most likely, Biden administration will remove that SALT limit, right, and again provide some sort of tax offset, tax deduction for people that are paying income tax to California, New York, and other high tax states. Okay. So on the one hand, they're going to remove some tax strategies, but they're also going to make it not as harmful to live in a high tax state because they're going to remove the SALT limit.
Got it. Okay. No, that sounds good. At least that's something good for the blue states, right?
And you could imagine California, right? Different states have something called conformity, right, which is to what extent do they follow federal legislation, right? So if you live if you're a California taxpayer, it's like you have to do taxes for like two totally different countries.
Yes.
There's the IRS taxes. And then you have to figure out, okay, what did California follow, right? When the TCJA came in, California is very quick to say, wow, all these other things that'll perhaps make higher taxes, we're going to adopt those.
Right.
Anything that will lower your taxes, no, we're not adopting. So ironically, though, you could end up a scenario where theoretically, Biden can say, hey, we're removing these tax benefit for real estate, and California could retain it.
Okay.
Theoretically, it's possible. Highly unlikely.
Right. Yeah, California. I'm hearing that of course they will add even more taxes. So let's see what happens. All right. No, this was great. Did we forget to cover anything before we take a
I,
break?
well, we've kind of scratched the surface. Each of these are really broad and deep
Right.
topics. What I would say is that now, people should not don't do anything, rash just for a tax benefit. But I think it is a time to exercise due diligence. When you're working, when anybody is presenting you with tax tools, say, right, I happen to have a very specific focus on self-directed retirement accounts. That's self-directed QRP, IRA, 401k. These are accounts that have, for the most part, flown under the radar, right? But they're growing in popularity. And if a Biden administration is given the ability, is going to give the IRS back their stick, there may be greater enforcement in this area and any other area. So I'd say when people either for themselves or promote other tax tools, important to do your due diligence, understand who you're working with, and see, do they really have the background that that supports providing the service, or are they really selling you something? Again, tax tools are about investment. It's just, hey, you're getting your ROI. Your ROI doesn't come in the form of rent, but it comes in the form of saving taxes. But at what risk? Are you really getting, are you buying a property, or are you essentially buying into something that's not going to give you the benefit? So if the IRS doesn't have a stick, you can get away with everything. But if they get their stick back, people have to be more cautious.
Right. No, that makes sense. So let's take a quick break, and after the break, we'll go through fire round.
Okay, let's do it.
You're listening to the Wealth Matters Podcast.
The Wealth Matters Podcast.
For more info about what we do, check us out at wealthmatters.com. It's wealth, WEALTH, matters, MATRS.com.
Welcome back to Wealth Matters Podcast. And Bernard, pretty much trying to untangle the upcoming tax changes, and those tax changes may come or may not come, but we just wanted to be prepared. So Bernard, are you ready for fire round?
I'm as ready as I'm going to be.
Okay. Would you be changing any business or investment strategy after coronavirus is over?
Yes, but it's not. But to be honest, it's not really dictated so much by coronavirus. I tend to try to adopt strategies that are long-term and not based on specific events. A great book for people to read, a great series is Incerto by Nassim Nicholas Taleb. So these kind of COVID-19 things, we're always going to have events that we can't anticipate. So I'm not going to have any big adjustments based on the specific events. It's more about how my tax and investment profile changes. So it's based on that. As the business grows, as the types of, you don't want to be too heavily weighted. It's more about rebalancing than anything else.
Awesome. Favorite real estate or finance book?
Favorite real estate or finance book? Let's go with the Investor's Manifesto.
Investor's Manifesto.
By William Bernstein.
Okay, I have not read that book. Okay, I got to have it then. Okay. Any tool or website you recommend? Or you cannot live
401kcheckbook.com.
Okay, I got to check that out too.
Let's see. I suppose I have to say another website as well. So what I think is a great website is, there are a couple of good ones. If we're going to look for a finance focus, I'll tell you what I like. I'll give you an author, actually. So Forbes, right, has lots of different authors. And I find that there are tax authors. For example, somebody, Pat Riley, or is that Pat O'Reilly? Check his name, Pat Riley. Let's see, what's his name?
I think I've heard that name.
Let's see. Well, no, there was Pat Riley, who was the coach of the New York Knicks and the Miami Heat.
Oh, yeah.
Let's see. What was his name?
Maybe that's why.
What's his name? Because he writes tax stuff. Yeah. Peter J. Riley.
Okay.
Peter J. Riley. He writes about taxes for Forbes. He writes great stuff. A nice blend of fun and technical. I encourage everybody to read his stuff.
Okay. Awesome. Any advice for beginner investors?
Okay, there are three steps, three components of this. Number one, you have to take ownership and responsibility for yourself. Number two, though, don't think only about yourself, right? You've got to own it, but if you only think of yourself, it's going to be meaningless. Number three, you've got to take action. Don't postpone taking action. So those kind of the three things. You have to have kind of your sense of purpose. You need your responsibility, your purpose, and your action.
Those are some great value bombs right there. How do you give back?
I give back in many different ways. Obviously, there's one way you're giving back, and this plays into taxes. Obviously, I'm not a fan of when people say raise taxes because we need to fund certain things or certain charities. I think the government is the most inefficient way to do things like that. And the best way, if you want to redistribute, is actually to do it yourself. Right? And you'd be amazed at the way the statistics play out. The people that are asking the government to raise taxes and redistribute, and the people that say don't raise taxes, may actually engage in personal charity at a much higher level, because the government's way of giving back is very inefficient. Beyond that, I do my utmost to share honest, objective knowledge about my areas of expertise, which is taxes and financials, all over the place. Wherever I can, I try to spread that knowledge so investors are empowered to make smart decisions and be protected from misguided ones.
Got it. That's awesome. How can my listeners reach out to you?
Google Reisz Financial or Bernard Reisz. You'll find lots of great info. Lead to the websites Agent Financial, Reisz Financial, and 401k checkbook.com.
That's awesome. Thank you so much, Bernard.
Alpesh, thank you so much for having me. I enjoyed the discussion, and hopefully this episode is part of sharing empowering knowledge.
Absolutely. Take care.
Thanks for listening to the Wealth Matters podcast. If you enjoyed it, please leave us a 5-star rating on iTunes so others can enjoy the show too. Have a great week and happy investing!